Okay, so it is recording now, and then we can start the discussion, right? So we go to page 59 is done. We go to page 60. So, okay. So here, of course, we're just continuing with the discussion of that foolish four strategy. So these, of course, these are things that you will see even in India. There are market gurus who will, from time to time, come out with like magic formulas with which you can make money in the market, etc. So those you have to take with a pinch of salt because essentially it's very hard to predict. But if you follow good risk control and you have I mean, I personally prefer trend following, but I'm sure you can also make money with the mean reversion approach. So if you whatever you have to have a consistent approach. You have to have some thinking behind it, and some research behind it. The main difference, actually, the main most important thing is risk management. If your risk management is very good, and then the market can never take you out of the game by bankrupting you, and then eventually, and in some periods, you're going to make money with your strategy. So that's the game, actually. So this is basically he's just criticizing this stuff and showing how they underperform the market. Right? So he's talking about why it fails. So these are his views on why it fails. Well, of course, this is a reasonable point about random statistical flukes. Okay, and this one is a little bit less. This is something similar to. Let's put it this way. Um, this is commonly said, but this is actually not a very good point because you can't really be sure that everybody's going to follow the January effect in exactly the same way. So the adoption of these methods is not actually uniform. So this is not such a good point. But anyway, this is not a major point in terms of learning value, right? So so everything here, he has some advice here. Okay, investing, speculating, this difference, as I said, don't take it too seriously because it's not a very specific difference. This is the third point, is again coming back to my point about risk management. This is the actual important point here, which is that you have to put limits on the amount they're willing to wager, whether you're so-called investing or speculating. Everywhere, if you limit your losses, if you go back to our spreadsheet, if we go to the spreadsheet here, we can open the drive file for this. And right, so we did that in the spreadsheet. You saw that we talked about when you have $100,000 of risk capital, you invest only $1,000, which was Malika's input. So, and that's a good way to think because that means you're very conservative, 1% of your risk capital per trade, and that kind of risk control. And if you can stick to that, that kind of risk control will basically is what will actually protect you. All right, so. So you look at what else he's talking about. Again, here he's talking about speculative versus investing. This is not to be taken that seriously because it's not a very specific distinction. Gambling instinct, etc. Here. So we go into chapter 2 and the discussion about inflation. So chapter 2 is about the investor and inflation. So we have now moved into chapter 2. And here the discussion is basically, so everybody understands what inflation is. So you have the two major indices that we use for CPI and PPI, for consumer price index and producer price index. If you look at the US, there are some other important indices as well, which is why I always tell everyone to study the US economy. If you want to learn about global finance, you have to study the US economy in great detail, because in the US economy, you will find there are some other interesting measures of inflation. Like the Federal Reserve has certain things called, since we're talking about this, so we just mentioned that. You'll find this in, if you want to look at it, you'll be able to find it. Let's look at it this way. So on page, the speculative versus investing part, okay, this we don't take it too seriously. We have already mentioned that not a specific distinction, okay, kind of a subjective distinction. All right, so this we don't worry about it so much. Okay, here we are on page 61. So I think I should give you some idea, because many of you nowadays, many of the jobs that are coming are actually KPO jobs to service the US market. So therefore, in addition to what I was saying initially about just that you can't learn global finance without studying the US market because it's the biggest market in the world. And now there's another reason to actually focus additionally on the US market, which is because a lot of the jobs are actually KPO jobs focusing on the US markets. So therefore, like Utsav was already doing some analysis of 10Q and 10K. These are the SEC forms that the US companies have to submit, right? So his job is already going into that kind of, and many others many other seniors of yours, super seniors, are I think doing this kind of work. So that's why another reason. So in many Indian management schools, including our school, you'll see this narrative that we have to, it must be Indian focused, India focused, and all that, which in finance especially is actually kind of almost ridiculous, because finance you have to study with the US markets focus and a global markets focus, because India is very backward in finance. And if you study with the India focus, half the things in finance you'll not learn, because most of the things are not here in terms of the products and kind of arrangements and transactions. So that's a totally wrong approach to studying finance. So don't buy into that. So get into the US markets focus, because that's how you learn global finance. So if we talk about some of the measures of inflation here, we are on page 61. We talk about some of the measures of inflation here, right? We are on page 61. So we just give you some basic measures of inflation. Okay, so everyone knows about PPI, CPI, I presume. Is that correct? Everyone knows about PPI and CPI? 1 minute. So PPI, CPI, right? These are very common, right? CPI is Consumer Price Index, PPI is Producer Price Index. Now, sometimes this PPI is called PPI is called WPI, Wholesale Price Index. Okay, so the Producer Price Index is another type of index, but these are very similar. Actually, these two are very similar, because the wholesale prices are essentially looking at the prices for producers, business output. And so they have CPI. Then you have another interesting one, which is, let me try and find the PCE chart here, if we can get it. There is something that the US Fed uses because the US Fed is the most important central bank in the world. Whatever kind of monetary policy stance they adopt, it's going to affect everybody in the world. So the US Fed and the US Fed policy stance has to be followed very closely. I hope you guys are following what's going on in the US, and also what's going on with China with the Evergrande collapse, and how it's affecting the decision making in the US Fed meeting. Because the US Fed is now working quite hard to give you a very kind of they want to tighten, but they also want to avoid scaring the market. So they're basically kind of trying to walk a tightrope there. They're saying we are going to taper, but we won't raise interest rates, etc., for one more year and all that. So they're trying to manage a very delicate balance. So US Fed policy also, you guys have to be totally focused on what's going on. So here we have PPI, WPI, and CPI. These you know already as standard measures of inflation. In the US, you have something called PCE, all right? PCE, which is, if you look at PCE is actually called personal, just write it with the bold, personal consumption expenditure. So in this, we're going to talk about a few things. Personal consumption expenditure. Okay, so this is actually a key focus of so we have these common measures of inflation. So we have this as 1. You have this as 2. And then you have this, which is actually a US measure. So this is only US markets. So PCE is US markets, is for the US market only. Okay, but you have the same idea. You can actually do the same kind of index in India as well. Okay, it is a key focus of Fed policy making So when the Fed wants to look at whether there is inflation in the U.S. economy, right? Remember, the U.S. Fed has a dual mandate, right? The U.S. Fed has to manage both, growth and inflation. So they have to have, they have to keep inflation under control. At the same time, they have to promote growth. So this is an actually contrast to the RBI mandate. So I'll write this a little bit about this also here. But it is a key focus of Fed policy making, which is as the main gauge of inflation. Okay, so the U.S. Fed has a dual mandate to control inflation and to promote growth, right? So when it comes to the inflation front, now there are many measures of inflation. So therefore, the question is, which measure of inflation should you focus on? So therefore, the U.S. Fed chooses to focus on PCE, and not only PCE, for all these measures, okay, all these measures like PPI, WPI, CPI, etc. There are two numbers that come out. One is, do you know what I'm talking about? Like when the CPI number comes out in the US, okay, there are two CPI numbers that come out. Do you know what I'm talking about here? What are the two numbers? So when the CPI data gets released, what will be the two numbers that will come out, both relating to CPI? Anybody has an idea? No? Okay. So let's note down a few points here. It is a key, one second, okay, as the main gauge of inflation. Okay. The Fed actually focuses on, so you guys should look up all these indicators, how they have behaved, get familiar with all these, getting into the depth of studying the US market. The Fed actually focuses on what we call core PCE, okay, core PCE, which means, so here, this is where you come to the idea of what are the two different indicators that come out, okay? So the Fed actually focuses on core PCE as the key gauge of inflation, okay? So for all, let's write this point, for all inflation indicators, okay, two numbers are published. Okay, one is the headline number, and two is the core number. Okay, so the headline number, the core number. So what is the difference between the two? The two numbers are published. One is the headline number, and the other one is the core number. Okay, so what how we understand the difference is that the core number is this applies to all the indices. All right, all the indices. Core number is the headline number minus core number is the headline number. So we are using this discussion of inflation in the Graham book as an excuse to teach you a little bit about measures of inflation and key important measures of inflation, especially what is the main focus of Fed policy in the US is personal consumption expenditures. Okay, so this, so here, so you have to also understand that for all inflation indicators, you have a headline number and a core number. So headline, and what is the relationship between the two? So this is that the core number is the headline number minus food and energy prices. All right, so they compute an index for the headline number, which includes food and energy prices. And when they compute the index for the core number, then they strip out they leave out the food and energy prices, and they compute the index for the remaining commodities or services, right? So therefore, this is so the logic here is that the logic is that food and energy prices. This is the thinking behind it. Okay, so you have to understand all this stuff. The logic is that food and energy prices are very volatile because they generally all these are all commodities. Okay, remember the Finviz futures chart we were looking at, all the different types of food items: wheat, rice, orange juice, coffee, cocoa. All these fall into really food items. And energy prices, of course, you have natural gas, you have crude oil, okay, you have heating oil, gasoline. All these prices, these are very volatile. So including them creates a um, overly sensitive or volatile data series. Okay, so if you look at the logic, the thinking is that if you look at the headline measures of inflation, CPI, WPI, PPI, etc., then the if you unless you strip out the food and energy prices, the indices will be the headline numbers will be very volatile. So you have to strip them out, and then you focus on the core number. So most of the analysts, when you look at the analysis of the inflation data that comes out, they will tend to focus on the core number. And in fact, the Fed also focuses on the core number for this index known as the core PCE. All right. So here I have found the PCE link in the Fed website. So I'll just share that with you. And so this is an important thing to learn about in terms of Fed policy. For all headline indicators, you have the core. So what you learned is the difference in the core index for inflation and the headline number for inflation, right? And so analysts tend to focus on the core number because this series is thought of as being less volatile because of the fact that food and energy is stripped out. Okay, so in the context, since we are discussing Fed policy, another important thing you should understand is that the Fed has not exactly connected to inflation, well, in an indirect way, yes, because we discuss inflation as well. Yeah, creates an overly sensitive series. Okay, in terms of the put it this way, the statutory or the legislative, well, let's call it the mandate. The Fed has a dual mandate. They have to control inflation, but also promote growth, and growth as in economic growth. Okay, so promote economic growth. So the Fed has a dual mandate. So we call this, now this is a technical term, so you should be aware of this. So when people say that the Fed has a dual mandate, what they mean is the Fed is required by legislation to basically focus on both controlling inflation and also promoting economic growth. That's the mandate of the Fed. Does anybody know what the mandate of the Reserve Bank of India is? Is it a dual mandate? Does anybody know? So let's make a line, and let's look at the line for this. We will put in a bracket here. The RBI. Let's. Okay, so I'll give you a hint. The change to the RBI policy, the RBI mandate was most recently changed in the time of Raghuram Rajan, so just a few years ago. So Raghuram Rajan put in place a certain institutional framework which requires the Reserve Bank of India to do certain things. So does anybody know what the RBI's mandate is? No? Okay. We'll just call it a single mandate. Not a dual mandate. Not very happy English here, single mandate. They just have to control inflation. Do you know the inflation bounds? Uh, they're not uh, they're not officially required to focus on promoting economic growth. But of course, as you know, in a democracy, when if economic growth goes down, it will not be good for the government. So generally, because the RBI is basically part of the executive branch, which although they try to be, some people were talking about RBI independence, but I'm personally not in favor of it. It's always better to have everything, let everything. So whatever they want to do, I personally prefer that the RBI. I don't believe in independent institutions anymore, after what I've seen over the last couple, especially over the COVID thing, and how institutions have become so corrupt. So I personally prefer everything should be under the control of the prime minister. So if the prime minister does a bad job, I mean, thankfully our elections are quite secure, so it's not so easy to rig our elections. The people will throw him out. So at least there is accountability. So I don't believe in this business of independent institutions. So, but that's just my opinion. So now the RBI has, so they're not officially required to focus on promoting economic growth, which I'll just leave it at that. But this is the important difference between the Reserve Bank of India and the Fed. So the RBI has a single mandate and they have to control inflation. Do you know what the bounds are for inflation? Do you know what the actual numbers are, the limits within which they have to keep inflation? Do you know? Nobody? No? You guys should know this stuff, man. I mean, this can come in your interviews. So you should be knowing all this stuff. Why aren't you aware of all this stuff? You're not tracking, you're not following business news sufficiently actively. All right. So they have to control inflation uh, between 6%, 6% and 2%. All right. Basically, the numbers come out as 4% plus. I don't know how to write this. How do I get 6 and 2? Basically, it's the rule that they have is 4% with fluctuations controlled under plus minus with all fluctuations confined to plus minus 2%. All right. So that's how I get the 6 and 2. 4%. This is the rule actually. This is the rule that Raghuram Rajan has put in place for the Reserve Bank of India. So now you have a monetary policy committee. Actually, one of my former professors from IMA is on that committee now, Professor Verma. Now, you see this, and if you notice, Professor Verma was, you guys should be actually, this is all about Indian financial markets, the Indian economy. You guys should be totally plugged into all these debates. So Professor Verma was actually one of the only people on the Monetary Policy Committee who was actually complaining about this ultra loose monetary policy, right? If you see one of the couple of I think maybe a couple of months ago, the meeting that they had, he was complaining about this because the RBI has kept monetary policy very, very loose, which means that the system is flooded with money and interest rates are very low, artificially low. So Professor Verma was actually complaining about that, and he was actually saying that I think it's time to start thinking about raising interest rates and trying to control inflation because inflation is also going above the upper bound, the 6% bound, right? So this is what you have to understand. This is a little bit of your knowledge about the Indian economy. And these are very, very important things. I'm surprised that you guys are not aware of all this stuff. You need to, step up your tracking of business news, your following of business news. All right. So we just keep this as a little thing within brackets to cover your, understanding. Since we discussed all this stuff, the inflation indicators and all that. So we wanted to learn about headline numbers and core numbers, the important, kind of measures in the U.S. markets. Okay, so let's look at this core PCE. So I'll just give you a link to this. Okay, you can do further research on this. So I'll just give you the Fred database. There's a very good database. The link to the PCE. All right, and you can do further research on that. Okay, so let's go back to Graham now. Let's go. What is this? They keep coming back. All right. Okay, so let's just read what he's saying here. So he's talking about right. So inflation, you have to understand, inflation obviously affects those who are earning a fixed amount. So any kind of fixed income investor will have a hard time when you have inflation, because they have already budgeted for a certain amount of expected inflation in demanding their nominal rate of return over and above the real yield. So they took the real yield that they wanted, and they added the expected inflation. But if the actual inflation exceeds the expected inflation, then it will start eating into their real rate of return. So this is a problem that fixed income investors have. And generally, the conventional wisdom is that stocks are a good hedge against inflation. But as we have seen even earlier in the notes, he has addressed this question even earlier in the book, where he has shown certain periods. I think it was something like the mid 60s to 1970 or something like that. In that period, which he showed, where I think it was 64 to 71, where he showed that these in this period, the equities actually equities did not work out very well as a hedge against inflation. So this is the problem. So the general view here is that um, yeah, so he's talking about how people have been talking about this issue, and he's describing how many people are now thinking that bonds are not very desirable because stocks are a better hedge against inflation. But then he will go on to basically he will go on to show you that. So he's talked about how a certain academic here, Jerry Siegel from Wharton, actually has recommended all these things. So again, these guys. So Jerry Siegel is an interesting character, because I remember there was an interview of who's the guy that I told you to read the notes from memos. Okay, memos from Oak Tree
Howard
Investments.
Mark.
Howard Marks. Yeah. See, my memory is actually my brain is blanking out. Very good. Thank God somebody remembered Howard Marks. Okay. So I asked you to read the memos, so I remember Oak Tree and the memos, but I forgot Howard Marks. So there was an interview of Howard Marks, who is obviously a very famous, one of the most successful value investors in debt. And so he was asked, he was talking about something, and so the interviewer said, you're saying this, but Jeremy Siegel from Wharton has said exactly the opposite. So Howard Marks said, he started laughing and said he's an academic, right? So basically, one more indication how, if you see, Buffett also is very, very dismissive of academic finance. So Howard Marks was also another guy who also is very dismissive of academic finance. So he was. So I remembered when I saw this Jerry Siegel name, I remembered that interview with Howard Marks. So there's a lot of material of Howard, a lot of interviews of Howard Marks on YouTube, just like you have Buffett and Munger also at the Berkshire Hathaway AGMs. So you guys should read all that stuff. Okay. So yeah, he's talking about those kind of absolute rules that under all conditions, if you have a rule that stocks are always better than bonds, you can't have any kind of absolute rules in the market, because the market is too dynamic. It's too unpredictable and too dynamic. So in this case, he just goes on to show that he does an analysis of the past, and so you can go through these numbers. These are no, I mean, we don't have to spend too much time going through the numbers, but the bottom line of what he does basically is he shows you that it's not as simple as that. It's you can't, because it's essentially unpredictable in the sense that there have been periods when stocks have not done very well as a hedge against inflation. So the basic takeaway from this is, as I would say, he's done a lot of this data. You can look at this data later on if you want, but I'll just give you the bottom line. The bottom line essentially is that uh, okay. Now again, he himself, although he himself is talking about not going with absolute rules, but he himself makes these kind of statements, and as you will see in the footnote, this kind of statement that he's making, that we think it's reasonable for an investor to base his thinking and decisions on a probable, okay, at least he's written far from certain, rate of future inflation of say 3%, right? And so this, of course, as you see in the footnotes, footnote 1, right? This is one of Graham's great misjudgments. Okay, the inflation actually hit very much higher levels. So basically, the message here again is that you should not ever get stuck in any of these absolute statements in the markets. You should understand the market as a completely wild and unpredictable universe where anything can happen. So anybody who thinks that okay, the inflation will, like I remember this kind of a statement where our former chief economic advisor Arvind Subramaniam, once he said that after crude oil prices had fallen to about 35 for a couple of few weeks. So he made a statement that, well, I don't think it's going up. Crude oil, I mean, he was very definite about it. And he said crude oil is not going above 45, will not go above $45. I mean, how was he so sure? Because within a few months, crude oil was trading at $75. So, but this is the problem with people who don't actually have to trade and manage money and don't have any accountability. So they can just say things. And then if they're wrong, there's nobody there to, pin them to a wall and demand accountability. So these kind of loose statements, you should be very careful. Never rely on these kind of statements. Okay. So all this stuff he's talking about, but eventually, yeah. So he says basically, eventually he does all this analysis here. Okay. Eventually does the analysis and eventually comes out with the conclusion that may do with far from certain. So this is the basic conclusion. The whole discussion of inflation, whether stocks are measures of inflation. Okay. And I'll just keep this here under this topic of measures of inflation. Okay. So Graham's analysis, which is analysis of let's put it this way. The question is, we have addressed this question earlier also in the notes. Are stocks a good hedge against inflation? We'll just write it once again. Question. This is all happening between page 61 to 65. The whole question of the discussion is starting on page 61. So the question is, are stocks a good hedge against inflation? All right. So the answer is we can't really be sure. Okay, this is the bottom line. And so basically, this is what Graham's analysis is. Graham's analysis of U.S. data, okay, shows that there is no clear-cut answer on this. Okay, so this is pretty much on every major question in finance and economics. There is no clear-cut answer, okay, because because whole finance and economics is the same thing essentially, because the same thing that is driving financial markets is also driving economic activity. What is driving everything is expectations. It's all about people's expectations for the future, and based on that, everybody wants to make money. So based on that, companies are setting up plants and coming out with new products, and investors are making bets, buying this and selling that, thinking that it will move one way or the other. It's all driven by expectations. So if you want to understand one word, which tells you everything about the economy and the financial markets, and that word is expectations, right? Everything is driven by expectations, and expectations are quite volatile and unpredictable. So that's why the market movements are also unpredictable, and economic data is also unpredictable. So all the things I told you about non-stationarity, all of it applies to economic data as well, and as also to financial asset prices. That's because they're all driven by expectations of human investors, and they are not rational, right? So they're not rational and they're highly volatile. So that's why market prices also end up behaving in that manner. Maybe if we forbade all human beings from trading, and we only allowed robots to trade, maybe things might become more predictable. But that's not going to happen anytime soon, right? And then there's the question of who would program the robots. But at least I think it would be much more predictable if only robots were allowed to trade and no human was allowed to trade or even do anything in the economy. So everything would be so human would stand on the side and watch, and all the economy and the financial markets would all be run by robots. Then things would be much more predictable. But obviously that's not a realistic scenario. Okay. So this is basically the upshot of all this 4 or 5 pages of analysis. That our answer to this crucial question is stocks may, but they are far from certain to do so. This is pretty much it, basically, right? So here, this is what he says. Yeah. Again, you have to be careful about these kind of things. Long-term future, say next 25 years. I mean, okay, if you ask somebody else, maybe if I ask Mayank, he will say no. For me, long-term is 5 years. If I ask Ruchi, then she will say no. For me, long-term is 10 years. So these kind of statements again don't make any sense because there is no standard definition of long-term. Okay, so these are all things that you have to be careful about. You should not write or speak like this because these are not standardized. So, all right. So here he's basically what he's saying is that people are not able to think about the long-term future too much. They are, he's just talking about a short period, like 5 years or so. He's basically saying that they most of them are determined by his short-term experience. Okay, this is basically short-term experience, and this here you can learn a little bit about behavioral economics. We can talk about we can mention this point because behavioral economics is a big thing. Uh, Although I personally think it's overhyped because your technical analysis, all the technical analysis that we do, that's nothing but behavioral economics. Okay, one of your seniors actually came to me and said that I want to do a course on behavioral economics. So I told him that you have already been doing behavioral economics because I've been teaching you technical analysis. So technical analysis is basically behavioral economics being practiced because we don't believe that people are rational. So we just try to look at patterns of behavior and patterns of stock prices. So basically that's the idea. But let's look at this point. So what he's talking about here, there's something you can learn. There's some kind of a little bit of the jargon of behavioral economics, which will help you in any market related debates as well. Which is, what is he saying here? Yeah. Okay. Right. So here with basically what he's saying on page 65 is that investor, put apostrophe s here. Let's put it this way here. That what is he saying? His hopes and aspirations. Okay. Let's put it this way. Hopes etc. We'll just write hopes, etc. Are driven by his experience in the short run, not long run. Okay, so this is basically it. So in behavioral economics, this is basically the part that I'm commenting on. So we say that in behavioral economics, have you guys all heard this term called behavioral economics? This is a new branch of economics. Okay, it's a bit quite a big thing now actually because many central banks like the Bank of England are doing all kinds of fancy experiments based on behavioral economics models and all that. I personally don't think that's a very good. I don't think it's very useful, but it's a fad basically. It's caught on. So when people in the market talk about it, so you should know what it is. So behavioral economics basically is we talk about a branch of economics. I'll just give you. Does anybody have any idea? Have you guys been taught about behavioral economics in your courses? No? Okay. So a branch of economics, you should know a little bit about this. Okay, so branch of economics that what do we say relaxes the assumption of traditional economics about a human agent, or let's say about humans being, this was a key assumption, that they are rational economic agents. So in traditional economics, we believe that human beings are rational economic agents But in behavioral economics, the main difference in behavioral economics is that we believe that we relax this assumption. In traditional economics, we work with the assumption that human beings are rational economic agents. But in behavioral economics, we relax this assumption. So we basically believe that um, human beings are not necessarily rational. And if you remember what we have, I might have said this to you once, we didn't really have much time to discuss technical analysis properly. We did do some, kind of loose analysis, but the idea here is that we in behavioral economics, the assumption that we what we say is that human beings are not necessarily rational, which is exactly what we believe in technical analysis. That's why in technical analysis you have to understand that in technical analysis, I might have mentioned this to you in response to somebody's question, that in technical analysis we do not care about why a market has moved in a particular way, right? We only want to know which way it's going. It's like surfing. So the surfer, a top surfer, will not be wondering about why this wave is coming this way, etc. He just wants to know which way this wave is going. So he has an instinct for the waves, and he's just trying to figure out which way the wave is going. So it's the same thing in technicals. We don't care about why the market is moving. We only want to know which way is it likely to go. So here, so therefore, then the reason we don't care about why the market is doing what it's doing is because we don't believe that the market is rational, because the market is made up of economic agents, and we don't believe that economic agents are rational in their actions. So what's the point of asking why he's doing something? Because if it's a madman, if it's a certified lunatic is kind of throwing a knife at you, what is the point of asking why is this guy throwing a knife at me? Because he doesn't need a reason to do things, right? So this is basically the point you have to understand is behavioral economics and technical analysis are actually in the same camp, because their fundamental assumptions are the same. So here we say the branch of economics, the results where human beings are like rational economic agents. Okay. So in behavioral economics, I started with a different point actually, and then I went into the discussion about technical analysis. We call this, let's put this in. What is he saying actually here, Graham? What Graham is saying is that investors are driven by, they are basically their moods, their hopes and aspirations, and eventually their decision making, right? If all these things are going to affect, because especially if we are not rational investors, our satisfaction, discontent, hopes and aspirations, all these things are going to drive their decision making. And so what is driving the decision making is not the long-term outlook or the long-term outcomes, but rather the very short-term experience from year to year. This in behavioral economics we call this the recency effect, which means basically that people are influenced by more influenced by recent events than they are by slightly longer term events further out in the past. So this is called the recency effect in behavioral economics. So I just wanted to mention that, which is basically similar to what Graham is saying. And we can also mention that behavioral economics is philosophically similar to technical analysis. They share a common assumption that investors are not necessarily rational. Okay. This is basically the common assumption. Although in technical analysis, even if you read some of the books that I've given you, nobody really spells it out like that. In none of the books in technicals, they spell it out like that. But this is what you have to understand. The key difference between, and it also helps you to understand the difference between fundamentals and technicals. So if you go back to some of your previous batches, some students have asked questions about whether I should use technicals or fundamentals. Okay, so the question is like that. So the answer to that question is you have to use a method which is consistent with your worldview. I mean, is this something you believe in? So you have to use a method that you believe in, because otherwise you will not be able to apply it over the long term consistently. Okay. So you have to choose a method that you believe in. So therefore you have to ask yourself, you have to understand that the main difference between technicals and fundamentals is this belief. Okay. Assumption that investors are not necessarily rational. Okay. And they may never be rational. So in technical and in fundamental analysis, that's why in technicals we never ask why is the price going to move in this direction. We never ask this question. Okay, but in fundamentals, you see people are always asking, and it's actually quite natural for human beings to ask this question. So because we always want to know why something is happening. But in this case, in technicals, we don't care about that. In fundamentals, we are always caring about that. What is it? Why is so in fundamentals? Why are you asking this kind of question? Why did the market move in this way? Why are you asking this question? Because you believe that if you know why this happened, then you can figure out what will happen in the future. Okay, that means you think that the market is rational, right? So that's basically the difference in fundamentals, with respect to technicals. In fundamental analysis, if you believe in fundamentals, that means you believe that the market is fundamentally rational. That means eventually like a kind of a value investor, even if it deviates from the fair value, your perception of fair value, it will eventually come back to a kind of a rational pricing, which is basically where price will equal your price, your assessment of fair value. But you can already see how problematic that concept is, because fair value is a subjective, largely, other than arbitrage free valuation, fair value is a subjective quantity. So your fair value is different from some other people's fair value. So how do you know which fair value the market is going to gravitate to? So it's a highly problematic kind of assumption in fundamentals, but people cling to it. Most people, if you'll notice, the majority of investors and professional money managers, they don't like to say that they are using technical analysis, because technical analysis, in technicals, we don't believe that we don't have to look for rationality, and so most people are not comfortable with that. So most people prefer to say, at least what they actually do may be different. They may actually be using a lot of technicals, but they will never say it, because they're afraid that people will think they're kind of lunatics or something like that. So they may use technicals, but they'll not talk about it, because generally it's more popular to say that we believe in fundamentals. That is the more politically correct thing to say in the investing business, right? So that's the reality, that people don't like to talk about their use of technicals. But actually, technical analysis is a very useful thing, because the advantage that technicals has is that technicals is very sensitive to the market. It does not fight the market. If the price moves, then we change our opinion. If the price moves against us, after a point, once it goes through our stop loss, we change our opinion. So in technicals, we are much more flexible and much more closely tracking the market. And that's why if you trade with technicals and you're disciplined, you will not lose too much money, because you will not fight the market. All right. So this is basically the difference you have to understand. The difference between fundamentals and technicals is this idea of rational investors. That's the real difference. So coming back to the question of whether you should use fundamentals or technicals, the way you have to approach this is you have to ask yourself, what do I believe? Do I believe that the market is fundamentally rational, that eventually it'll come back to fair values? Or do you believe that, no, I don't think the market makes any sense at all? It's just randomly whipping around here and there. And so then if you believe that, then you're more comfortable using technicals, right? So I personally prefer I use fundamentals for different asset classes in different to varying degrees. But whenever there's a conflict between, especially in the more liquid markets, when there's a conflict between the technicals and the fundamentals, I will always go with the technicals, because the technicals keep me much more closely tied to the market price. So I basically don't fight the market too much. If the market moves too much against me, then I just give up, take my loss, and move on to the next trade. And this way you can stay alive. Okay, if you fight the market, eventually the market will take you out. The way to stay alive is not to fight the market. All right, so this is the important point about this is also important for your own app practice in the future, that how do you choose between technicals and fundamentals. So I'll write maybe this a little bit here. Philosophically similar, they share a common assumption that investors are not necessarily rational. Okay, uh, I'll just write this here. It is on this crucial assumption that technical analysis differs from fundamental analysis. So this is what you have to understand. Interestingly, you will never find this in any textbook. But I'm telling you, this is the real difference between, and if you think about it, you'll understand it. This is the real difference between technicals and fundamentals. Okay, so technical, this is on this crucial assumption that technical analysis differs from fundamental analysis. All right, so now let's go back to on page 65. Okay, this we are talking about the recency effect in behavioral economics. This is a term that you should be aware of. And the recency effect is also another thing I should also give you a connection to. That is, you studied two things, momentum and mean reversion. Can anyone tell me which of these two is more closely related to the recency effect? Or which of these two is more consistent with the recency effect in behavioral economics? Is my question clear? You have studied momentum investing and you also studied the mean reversion approach to investing. Now, like value investing is a mean reversion approach. Now, when we are talking about this phenomenon in behavioral economics called the recency effect, my question to you is, this recency effect business, is it more consistent with momentum investing or with mean reversion investing? Anybody? No?
Mean reversion.
Mean reversion? Why? What is the recency effect? Let's understand the recency effect. Let me explain the recency effect once again. The recency effect in behavioral economics says that people are influenced by, people are disproportionately influenced by what is happening in the very recent past. So they tend to forget about what happened, like let's say maybe several years ago. They're more concerned with what, I mean, they get heavily influenced by, ideally, what they're saying is that ideally people should give equal weight to all the events in history, like whether something happened 20 years ago or 10 years ago, everything should have equal weight. And whatever happened like 3 days ago or 2 days ago, everything should have equal weight. But if you are rational, but what behavioral economics says is, well, people are not rational. And so what they have found is that people actually tend to give disproportionately heavy weightage to the events that happened in the very recent past, as opposed to things that happen in the more distant past. So is this clear now? This is what is the
So
recency effect. So
momentum,
now,
so it would be then
yeah, it should be momentum.
because
Why?
yeah,
Yeah.
because the momentum focuses on the recent performance will persist, like stocks that outperformed will continue to do so in the short term.
Okay, very good. Yeah, that is actually the right answer. So that it is actually momentum investing, which is more consistent with the recency effect. Because basically, what is momentum investing? Momentum investing is if you take the stocks that have gone up the most in the last 1 year, you go. This is the academic approach to momentum investing, but they get the basic idea, which is that whatever has gone up in the recent past will continue to go up. That's the main idea in momentum investing, right? So it is more consistent with the recency effect. So you need to see all these connections. Okay, this will improve your overall conceptual clarity. So the recency effect Okay, the recency effect is supportive of a momentum investing approach. Okay, this is the idea. So there's a lot of a lot of academic work has been done on momentum investing, but again, it's very academic. Most of the analyses are very academic. They don't seem to be very plugged into transaction costs and what kind of psychological toll it takes. In most of the academic studies, actually, you'll see they'll do all kinds of studies about, okay, you hold this portfolio of stocks, but in between there'll be fluctuations, and they don't understand what kind of psychological toll it takes for a human being to sit through a big drawdown in his portfolio, right? So these kinds of issues are never addressed in academic research. They just kind of do these numbers because it's very abstract for them. But anyway, so there's a lot of work done on momentum investing in academia. So recency effect is supportive of a momentum investing approach. You should understand this connection. All right. Okay. So we can actually put this also in brackets. Behavioral economics is philosophically similar. We have mentioned this. Okay, right. Now we can go back to this point. What is he saying here? We talked about this. But let's see what he's saying next. Okay. Yeah. So this is basically the what he's saying once again, that which he's already said, that there's no, basically you can't rely on this statement that stocks are a good hedge against inflation, because it's not really supported by the evidence. It may sometimes work out, but it may not work out as well. So because the stock earnings and stock prices, these are driven by many factors. Okay, so mainly the logic of inflation is that earnings. The main logic of inflation is that of the stocks being a good hedge of it against inflation is that when you have an inflationary trend, every company is able to raise prices because prices in general are rising. So that will increase their earnings. Okay, that will increase their revenue, and assuming everything else, all the other cost items remain the same, it will increase their earnings. But that's the problem with that, is that it doesn't take into account all the other things that affect revenues. First of all, revenues are affected not just by price but also by quantity. So you may not be able to sell that much because maybe there's not enough demand, or maybe there's supply shocks or this and that. There are all kinds of unpredictable influences, and that's why you can't make these kind of general statements. Okay. Yeah. Again, the same thing that I just told you here. He's just mentioned this again here, that um, there is again no relationship between the uh, no relationship between the earnings, right, and earnings rate on capital, and the with of course here, but basically with the cost of living and all these inflation indices, right? So there's no inflation here. 1 minute, let me just check where I hope I'm not exceeded the time. What is the time now? Is it 8:30? No. So okay, so we are running this class till 9, right? So we have half an hour. Yeah, I just wanted to make sure that we are keeping track of the time. Okay, so here he is talking about the same thing, that uh, talk about depreciation and all that stuff. Okay, this here what he's talking about. This part is obviously we talk about this. We can just make a note about this. Uh, he's talking about here the earnings yield. This is the earnings yield, and expressed in reverse as price times earnings. Okay, so this we have to understand this clearly. Are you guys all familiar with this expression? So which page is this? Let's make a note of this. Page 66. Okay, times earnings. I'll make that note. So page 66 here, and we'll just make a note here on about page 66. Here, page 66, right? So he's talking about times earnings. Okay, so when he says times earnings, times earnings. All right. So here you have goodness, okay, times earnings. Now here, this part, what he's talking about, two things here. We need to be clear about two things. One is the, put these in bold, earnings yield. How do you calculate earnings yield? Anybody? Yeah. Earnings yield? Nobody? Okay, let's see if there is. Okay, so earnings yield basically is, as he's saying here, look at
Sir,
this.
I'm not sure, but it is EPS by stock price.
Yeah, so it is earnings per share by price per share. Okay, so you're correct. It is EPS, okay, earnings per share divided by price. So price is obviously per share. So it is EPS by price. Okay. Now, what is the reverse of the earnings yield? That's what he's talking about here. What is, let's see first what he's talking about. Okay, so the earnings on the current market price, so which is basically here he's talking about the earnings yield. So this earnings yield is 6.5. Now he's saying this is mentioned normally and discussed in the reverse or times earnings, right? Which is basically here the trailing TTM, trailing 12 months earnings, which is 18 times. So the Dow, he's what he's saying, the Dow is trading at 18 times earnings. So what is the reverse of the earnings yield? What would we say? The, in maths we will say inverse. The inverse of the earnings yield is equal to what? Yes? Anybody? The inverse of the earnings yield is what? No? The inverse of the, let's do the inverse first, no? Then we can see what it is. What is the popular name for this? We just do the inverse of this, right? So what is the popular name for the RHS? Anybody? No? What happened? This is one of the most common things that you look at. Let me try and get the
Price to earning,
Microsoft stats here.
price to earning ratio.
What is this? Right? Okay, so this is basically what you need to learn. Yeah. Yeah. So this is the inverse of that is basically the PE ratio, the famous PE ratio, which one of the first ratios that you learn about. So the inverse of the earnings yield is the PE ratio, right? So that's what we are talking about. So that's basically what one thing. So this is good to, because as we can see, not everybody was completely on the ball with that. So it's a good thing to discuss that. That here it's an opportunity to refresh your concepts between involving the earnings yield and the price earnings ratio, right? So you look at the earnings yield. So just like you look at the dividend yield, which would be the dividend per share by the price, you also look at the earnings yield, which is EPS, earnings per share by price, and the reverse of the earnings yield is the PE ratio, right? Which is quite famous, most commonly used actually. So that's what he's talking about here. All right. Right here, his again these kind of statements he's making, which we may have these general kind of statements. Say you can assume this kind of return and all that. Again, it's based on that calculation of the rate of growth of earnings. It's into the retention ratio, which we discussed earlier. Retention ratio into the return on equity. So he's basically again saying that the growth of earnings is coming from, this is the traditional view, and he might not be wrong actually. But in fact, it's very difficult to figure out exactly what is driving earnings. But certainly, if you have reinvestment, that will make a contribution. Of certainly, you can't ignore that contribution. What he's saying is that the growth of earnings is not coming from inflation, but it's actually coming from the returns that the business is generating from reinvested capital, from reinvested profits. That's basically what he's saying. So he's basically again, torpedoing the theory that earnings stock, earnings of stock, share earnings are driven by inflation. They're proportionate to inflation. He's saying that's not the case. So, right, so basically, they're saying that this does not happen. Yeah. So he's saying this has not been the case on the basis of the past record. Basically, you can't predict. So there's no point in, and it doesn't really help you. It's not a very useful kind of, because it's too general a statement that stocks are a good hedge against inflation. That's too general a statement because the real decision problems that you will have is basically which stock to buy and at what point to buy, how much to buy, and at what point should you exit. These are the real decision problems. So those do not get addressed by those kind. Those are very specific. Those require very specific solutions. And these kind of general statements like stocks are a good hedge against inflation, these are not very useful in terms of the actually managing money. So it doesn't. These are general statements that TV commentators like to make, but they're not very useful in the real world when you have actual problems to deal with. Right? So here, there's more of that actually. Okay, so he's talking about other things that operate. That's what I was saying earlier, that there are so many influences actually on earnings that it's very difficult to just expect that inflation will be able to influence earnings. Okay, it certainly plays a role in raising the price level, but then your value or your total earning, your revenues are actually driven by both price and quantity. So there are many other things that might affect quantity. So the total revenues may also, even though prices have gone up, total revenues might decline because your quantities will go down for various reasons, all kinds of disruptions. Okay. So all these other things that he's talked about here, the need for high levels of capital investment. And here you can see yeah, so he's talking about the growth of corporate debt, and of course, this is actually even more. This phenomenon here is actually it's surprising that he's actually he's shocked by this. But if you see what has happened to corporate debt after the global financial crisis and after the central banks kind of made it clear, pretty much by 2011-12, it was very clear that central banks were never going to raise interest rates by a large amount. So therefore, corporates took that clue, and even companies like Apple, which don't really need money and they don't really need debt, but they also started issuing debt because you could do it at very low rates of interest. So they've also started. So there's tremendous growth uh, the of corporate debt, not just between 1950 and 69, but especially after 2000. 9-10, there's been an explosion in corporate debt, which continues even today, actually, because obviously central banks have not changed their posture. They remain, super accommodative, and they're very, very supportive of the economy. So everybody knows that there can't be too much of a economic downturn because central banks will keep flooding the. I mean, there is an economic downturn anyway, but there's the central bank. What people understand is that central banks will not tighten monetary policy too much. They will not raise interest rates too much. That is pretty clear to everybody now. So that's why people have become much more reckless in their use of debt. So you can see here that the here debt has exploded, and basically your operating profit after paying, I mean, your profit before taxes, this is after paying interest, but their profit has not gone up that much, but debt has exploded, right? So these are other things, other influences. Now, and also there was also the other problem is that interest rates were also rising during this period. So therefore, that was a kind of a double whammy, that your total debt is going up and interest rates are also going up. So this is basically what he's talking about. Says further analysis. You can look at these tables here. But again, he's on that same point because this chapter 2 is about inflation. So he's basically talking about, further, he's doing further analysis of why it's good for you to read all this stuff, because all of it is new for you, and you will get, more ideas on what else to explore, etc. You should read the book from end to end. Although certain parts you can move through quickly because he's basically repeating the same point. You can see. So basically, what he's saying is a lot of the return on equity is actually happening by coming out through leverage. Okay, so if you here, there's an important point actually to learn, important element of corporate finance theory that we can actually make a note of, which you should understand. Okay, which is, let's look at. So the point he's actually talking about. The point is, what is the point that he's making? He's talking about that the return on equity is accomplished by a use of a large amount of debt. All right. So if you look at this, this actually brings us to an important point which we should sort of revise here, which is, let's make the note of the page number, which is page 68, which is here. Okay. Now we should make a note of this, which is the key word here is that. The part that I'm quoting is the just say high return. This is not the exact quote, but the high ROE is being achieved through the use of debt. So that's what he has said, of high levels of debt. Okay, the use of high levels of debt. Essentially, that's what he's saying. Okay, high levels of debt. Okay, here we come to an important concept, which is we have an important concept here, which is this. This is the relationship between three things. Okay. On the one hand, one is ROE. One is ROE. Okay. Then, sorry. Okay. Next is and everyone understands ROA. What is ROA? Yeah. ROA. Anybody? Let's write all the figures anyway. So what is ROA, guys? Anyone?
Return on assets.
Correct. Return on assets. Okay. So ROA is return on assets. So, all right. Okay. So there are three things. Okay. So there's a learning here which to basically relates to this point that Buffett is or Graham is making here, which we can use to learn this important point. That what is the relationship between ROE, the after-tax cost of debt, and the return on assets. Okay, so basically what we want to say is, now suppose, let me ask you the question that um, if you have, let's say if you have a certain after tax cost of debt and if you have a certain return on assets, what kind of relationship between the after tax cost of debt and the return on assets? Let's put it this way. Let me ask you this way. If so, return on assets, first, let's be clear about return on assets. Are these assets, when we say return on assets, are we talking about the assets financed by debt and equity, or only by equity, or only by debt? Yeah, anybody? Okay, so we are talking about, so this is, you can call it ROTA as well. So this is return on total assets. When we say return on assets, we mean actually return on total assets. So we can actually write that as ROTA as well, but normally we just write ROA. So what you have to understand is the return on total assets is the return on the total asset block, which is financed by both debt and equity. So conceptually, you have to understand it that way. It's a total assets. Now my question is, if your return on assets, okay, if, now let's ask this question, if the return on assets exceeds, okay, or why don't we just use mathematical symbols, is greater than the after tax cost of debt. Okay, so if you take in any period, if the return on assets is greater than the after tax cost of debt, okay, then what will happen to return on equity? We can actually remove this. The tax cost of debt here. If the return on, we will not write total every time. It is understood that return on asset means return on total assets. If the ROA is greater than the after tax cost of debt, then what will happen to return on equity? Will it increase or decrease? In order to understand this question, you remember that I have taught you this concept in accounting related concept. I think hopefully we have covered it. That net worth is a residual. I think I might have covered it in lab while teaching the Solomon case. I hope people have not forgotten. You remember what net worth is, right? Net worth is a residual. You remember net worth? What is net worth? Net worth is share capital plus reserves. All your retained earnings, it's everything else, right? So all the reserves, all the money that belongs to the shareholders is called net worth. So net worth is a residual quantity in the sense that net worth is, so what you should remember here is, you can say it's a clue kind of thing, in a sense. It's a clue that total assets minus outside liabilities. You remember this term? Outside liabilities is all liabilities other than net worth, which is net worth is whatever belongs to the shareholders, which is share capital and reserves. So all liabilities which are not liabilities to the shareholders of the company, those are called, in finance we call it outside liabilities. So total assets minus outside liabilities is equal to net worth, okay, because is equal to net worth. So this is your clue, and this is why net worth is a residual quantity, because as the value of total assets fluctuates, you cannot change the outside liabilities, because these are all like bank loans and other debt payable, liabilities, trade debts that you have, okay, accounts payable essentially, right? So none of these things are such that you can alter their face value. You can't go back to the bank and say, sorry, my asset values have gone down. Could you, I borrowed $100 million from you, but could you write the loan now as $90 million? The bank is not going to do that. Nobody's going to do that, right? So if your asset values fluctuate, which is quite common in business, because your business fortunes are fluctuating, so then the hit has to be taken by net worth, because these guys are not going to change. So if total assets go up, then net worth will increase. If total assets go down, then net worth will decrease. Okay, so this is your basic accounting equation, which basically tells you that net worth is a residual, because if there's any change, then if there's basically all the losses have to be borne by the shareholders, right? Now here, based on this clue, if this is a clue at all, then what will happen to return on equity? Will it increase or decrease? Well, what? If ROA is greater than the after-tax cost of debt, then okay, what will happen in this? So you suppose you take on fresh debt, and you do add a project onto your books, and you take on fresh debt, and that has a certain after-tax cost. But on that asset, on that project, your return on assets is greater than the after-tax cost of debt. Then what will happen to return on equity? Will it increase or decrease? No? Anyone? Conceptually think about it. The return on asset is the total asset block. Okay, it's the total asset block. You're realizing a return on the total asset block, and the total asset block is financed by debt and equity. There's a total asset block. Total assets is financed by debt and equity. So if on the total asset block you're making a return which is higher than one of the components of your cost of funds, then obviously the return on the other component of your funding, which your capital, will increase, right? You got to think about this. It's an important concept to understand. Okay, so this is one of the basic rules of you can say corporate finance or whatever, but this relationship you should understand. My spelling is not correct, right? So you should try and think about it conceptually and try to internalize this concept. It's a very important thing to understand. So please go back and revise all your accounting principles, your hierarchy of claims. Understand that obviously you know that debt holders get paid first, then the hybrid capital holders like preferred shareholders, then the equity holders. And within debt, of course, you have senior debt, which will get paid high before the subordinated debt. And then, of course, as you saw in the Solomon case, if there is a secured creditor, he will have certain assets that he can seize and use them to get himself compensated. But the unsecured creditors are left high and dry if there's not enough money left, right? Which happened in the Solomon case. But you have to then revise all this stuff and understand this concept, the total assets minus outside liabilities. So all your bank loans, accounts payable, other short-term debt outstanding, long-term debt outstanding, everything. And total assets minus this is equal to net worth, which means, again, you look at this, you take this outside liabilities to the right-hand side. Total assets is therefore equal to the two types of capital. The outside liabilities is essentially debt, and the net worth is the equity. So if you take this to the right-hand side, you can write this equation as total assets is equal to debt plus equity. This is basically debt, and this is equity. You take this here, you get debt equity, which obviously you can start with that because it makes sense. Okay, that everybody understands. All right. So please make sure that you understand this point. That it may not be intuitively obvious at this point, but you think about it. Okay, that you're financing an asset block, which you're doing a project. The asset block is financed by two types of. No, obviously you have to change this here. If return on assets is less than the after-tax cost of debt, the return on equity will decrease. So you have to make sure that you understand this, okay? All these types of questions are all kind of related to balance sheet analysis and your financial statement and ratio analysis. And these are typically the kind of questions that you get in the interviews. And also most of the jobs these days are still, most of the demand for the jobs is really on this corporate balance sheet analysis, valuation related work, right? So that's where most of the demand is. So you have to make sure that as a finance student, your concepts of all these ideas are rock solid. So you have to practice all this stuff and you have to make sure that you understand these things intuitively, conceptually. So you have to practice, and so let's make sure that the writing is correct. So if the return on assets, so this is important because in this point, what he's talking about is basically that a lot of the increase in the return on equity is being achieved by, accomplished or achieved by using a lot of debt. Okay, and you see, after tax, he's talking about the same thing here, and the cost of the debt is quite low, which is 4% after tax. The after tax cost of debt is quite low. And so what he's saying is the same thing. He's basically, that's why I mentioned this point, and this is an important thing to understand in corporate finance, that this relationship, the relationship between ROE, okay, and after tax cost of debt and return on total assets. Okay, so what the rule that what we have to understand, you make sure we don't have further time here to give examples and all that, but you play around with this on your own and see how it works. It's actually, you don't need examples. You have to think about it conceptually. You should understand it conceptually. If you look at if I give you number examples, number based examples, those will not be, I mean, it doesn't clear your conceptual, it doesn't clear your concepts. You have to visualize this, that you have a total asset block which is financed by both debt and equity, and the return on the total asset block, whatever, let's say 20% or something like that, is greater than the after tax cost of debt. So the after tax cost of debt is basically what you have to pay your, I mean, the net cost of servicing your debt. And then on that, the debt component of what has financed that asset block, that return is that the cost of that debt is lower than the return on the total asset block. So there is a little bit of a surplus concept, and remember that net worth is a residual, so the surplus will go to net worth. That's why the return on equity will increase. Okay, and similarly on the other side, if you make a ROA which is less than the after tax cost of debt, then the return on equity will decrease. So you should keep on thinking about it, and it's actually should be clear to you from a purely conceptual, abstract conceptual point of view. You don't even need numbers to think about it, because there are only two components. If there had been multiple components of debt, we could have thought about some numbers and all that. Multiple components on the liability side of the balance sheet, but we have only two types of things. Well, we just ignore hybrid capital like preference shares. We just say debt and equity. So with two things, it's very easy to visualize, and you should make sure that you understand the very important concept in corporate finance. All these concepts should be crystal clear to you. I'm surprised that many people aren't jumping up and answering this promptly. All these things which I've mentioned written here, that you can just put this on the right hand side, it's the same thing, that you know total assets equal to debt plus equity. All these things you have to understand. Your accounting has to be rock solid. Everyone should understand. You should be very clear about your journal entries. Okay, I think I might have mentioned this somewhere before as well. That you should, every person should be, if you can't be a finance student without having strong accounting. So you have to make sure you understand journal entries, and you can pass the entries for any transaction. All right. So we'll leave it here now. We have just crossed about by 1 minute. Okay. Am I right? That's the right time size. So 7:30 we started, and so 9 o'clock, right? Okay. Is that correct? Okay. So all right. So your attendance has already been marked, and we can actually then, so attendance is marked. So next time I meet you at today is Thursday, right? And so Saturday there's no class because of Gandhi Jayanti, and so the next class is on the next Thursday. All right. Okay. Anybody? So the class is dismissed. As I mean, anyway, this was just an optional class. But so anybody has questions can go ahead. And the rest of you, I mean, we are done with the formal class. I wanted to make sure that I completed a 90-minute session rather than doing a half-baked session. So yeah. Anybody has any questions? Sorry, I have nothing here on the note here. Yeah. Okay. Anybody any questions? No? Okay. I hope you can hear me. Can you hear me? I hope I didn't go silent. Let me ask somebody in particular. Can you hear me? Who
Yes,
should we
sir, we
ask?
can hear you.
Okay. Okay, you can hear me. Okay, fine. So no questions, right? No questions then. So okay, fine. Then we'll end the session. So once again, my apologies for the afternoonish problems, but at least we were able to do a full session with everyone who was in a position to attend, and then I'll be uploading the video as well, so everyone will have access to the video, and that's pretty much like it is, except that you can't ask questions if you are not present during the class. All right. Okay. So take care, and please make sure. So what I'm actually a little bit disappointed in the in finding out that more people are not clear about these concepts. Okay, which means you have to step up your both your following of business news and also your core concepts in finance. So you need to focus on these, because I think that you're running a little bit behind. Looks to me like you're running a little bit behind. Okay, so you need to watch that. All right. So I'm going to, so no questions, and I'm going to end the session now. Okay. And I'll see you guys on Thursday. Okay. Bye. Good night. All right. Oh, call is being recorded, so I have to stop recording.